Hey everyone! Today we're diving deep into two of the most explosive high-income ETFs in the market right now, MISTY and ULTI, both from YieldMax. But we're not just going to talk about the flashy yields or the ticker symbols. We're going to walk through exactly how these funds work, when it makes sense to invest, the crucial differences between them, and whether it's too late to get in. We'll also unpack something that's causing a lot of confusion lately, return of capital, what it means, why it's not just getting your money back, and how it could actually be a tax-advantaged way to get income. Then we'll wrap it up by zooming out and talking about where YieldMax is headed as a firm, and what the future of high-income ETFs might look like. Let's get started. First, let's acknowledge something a lot of people miss. YieldMax isn't just sitting back collecting assets under management, AUM. With nearly $15 billion in AUM across their ETF lineup, they could just ride the wave. But they're not. They're aggressively positioning themselves as the brand for high-income ETFs, especially in the single stock space. Unlike traditional ETF issuers who passively track indexes or slowly roll out products, YieldMax is releasing new creative tickers almost monthly. They're targeting not just popular names, but also momentum plays with real investor interest. They're doing this by designing synthetic covered call ETFs that combine equity exposure with income-generating options overlays. Think Tesla, Nvidia, MicroStrategy, Robinhood, Carvana, Palantir. These are not sleepy dividend names. These are volatile names with upside potential, and YieldMax is monetizing that volatility for income. Let's start with the big one, MISTY, which is YieldMax's ETF tied to MicroStrategy, MSTR, a stock heavily tied to the price of Bitcoin. Now, the most important thing you need to understand about MISTY is this. You should be bullish on MSTR if you're going to buy MISTY. If you think MSTR has room to run, maybe because you're bullish on Bitcoin, or maybe because you believe in the long-term software value of MicroStrategy, then MISTY is not too late. Because here's the deal. MISTY can generate a strong yield through its option strategy, but it will benefit much more if MSTR appreciates. If MSTR goes up 30%, you might see a total return, price plus yield, that blows away most other income ETFs. However, if you think MSTR has topped out, then what you're doing with MISTY is collecting premium income, but with downside risk. In that case, you need to evaluate, am I okay with reduced upside? Am I just looking for yield? Am I comfortable with crypto-linked volatility? If you're bearish or even neutral on MSTR, you may want to look at something more diversified, like Winter, which uses a less aggressive strategy, or YAX, which we'll cover later. Now on to ULTI, which is often compared to QQQ, the Nasdaq 100 ETF. ULTI is YieldMax's way of packaging 27 high-beta tech names into one basket, then applying a covered call strategy across the portfolio. Here's the great part. ULTI is not dependent on one single name like MISTY is. If you believe in the overall strength of the tech sector, if you think AI, cloud, semiconductors, and fintech still have room to run, then ULTI can be a really powerful total return play, and it's never too late to invest in something like ULTI, just like it's never too late to invest in QQQ if you believe in innovation. ULTI pays out income every 4 weeks just like the rest of YieldMax's lineup. And yes, it's synthetic, but it's built to harvest time decay and volatility premiums while still maintaining bullish exposure. That's the ideal combination for a long-term investor who wants exposure to growth stocks with income. Let's be honest. It would be incredibly hard to pick 27 terrible tech stocks today. It's easier to accidentally pick 27 winners, especially if you're focused on quality momentum names like Microsoft, Nvidia, Meta, and so on. But there is a risk. If the tech market underperforms or gets crushed by macro news, inflation, interest rates, regulation, then ULTI will hurt. That's the nature of being long volatility. However, YieldMax uses protective options in the fund structure to help soften some of the downside, so you're not fully exposed the way you would be with a naked long equity position. Let's clear up the biggest myth in ETF investing right now. That return of capital, ROC, means the ETF is giving you back your own money. No, that's not what's happening in most of these YieldMax ETFs. Here's why. ROCE is a tax classification, not an indication that the ETF is failing. Let's say an ETF sells a call option for $1. Then the underlying stock runs up and they have to buy back that call for $5. On paper, that's a $4 loss. However, if the stock itself appreciated by $10, the fund still came out ahead. The realized options transaction was negative, but the fund gained value from the underlying equity position. Because the fund made a distribution in a period where realized gains were negative, the IRS classifies that as return of capital. This is incredibly common in option strategies. In fact, QYLD, one of the oldest covered call ETFs, regularly has 90% plus of its distributions classified as ROC. Why is that a good thing? Because ROC is not taxed as income. Instead, it lowers your cost basis in the fund. That means you won't pay taxes on that distribution today. You'll only pay capital gains tax when you eventually sell the ETF, and if you hold it more than a year, it qualifies as long-term gains. In other words, ROC gives you tax-deferred income today. Now, there are times when ROC is just capital coming back to you, especially if the ETF is in a drawdown and keeps paying. But more often than not, in YieldMax's case, it's just a result of how the income is generated and how the IRS classifies it. So what are a couple of our favorite YieldMax funds outside of MISTY and ULTI? Let's look at two different categories: single stock YieldMax ETFs and index-style diversified ETFs. 1. Single stock, YieldMax Robinhood. Robinhood has had a bumpy ride since its IPO, but it's starting to stabilize and show real traction. If you're bullish on retail investing, crypto access, or Robinhood's pivot to recurring revenue models, YieldMax could offer upside with very strong yields. As a synthetic covered call fund, YieldMax captures Robinhood's potential gains but also sells volatility to generate high monthly income. If Robinhood pops, so does YieldMax. 1. Single stock carry Carvana. Carvana is a momentum beast, extremely volatile but also extremely rewarding for covered call writing. That's why carry has been one of the more exciting funds in YieldMax's lineup. Total returns have been strong, especially if you entered before a run-up. But again, timing matters. Covered call ETFs like this can lag the underlying stock if the stock rips too hard, because of the covered call cap. 1. Index style, YAX. Now here's a gem. YAX is YieldMax's fund of funds. It owns slices of nearly all the single stock covered call ETFs that YieldMax has released. If you're not ready to pick your favorite tech momentum stock or don't want to chase returns on any single name, YAX is a great way to get diversified income from a wide basket of high-yield single-stock strategies. It pays weekly, and you're getting the blended exposure of everything from TSLA to PLTR to ROKU to Coin. Think of it as a way to dip your toe into the YieldMax ecosystem. 1. Index style, 5E. 5E is a hybrid. It's part synthetic YieldMax, 60%, and part direct equity exposure, 40%. If you want more upside participation than a pure call writing ETF can offer, 5E gives you that balance. It's also powered by Dorsey Wright, a respected momentum research firm that selects which underlying names have the strongest bullish outlook. So it's not just randomly picking 5 stocks, it's based on trend signals. Looking forward, the future for YieldMax looks like more single stock ETFs, more index-style strategies, and more specialized hybrids. We're talking thematic launches, AI, crypto, retail innovation, zero-day option strategies, which they already have in some funds, inverse covered call ETFs, yep, that's a thing now, target distribution portfolios like Baiguai, aimed at institutional comfort zones, 12% targeted yield. The market is moving from traditional income ETFs like GPI and QYLD to customized high-octane vehicles like MISTY, ULTI, and YAX. And YieldMax is pioneering that shift. They know not everyone is going to buy into synthetic covered calls, but for those who do, and who want monthly or weekly income, YieldMax is becoming the brand of choice. If you're thinking about MISTY or ULTI, ask yourself, am I bullish on the underlying asset? Am I okay with some volatility in exchange for high income? Do I understand the trade-off between total return and capped upside? MISTY is best for those bullish on MicroStrategy and Bitcoin. ULTI is for the tech growth investor who wants income without picking a single stock. Both offer monthly cash flow, both use options, and both require that you understand what you're buying. But if you do, and if it aligns with your view of the market, then no, it's not too late to invest. As long as you know your risk, and you're willing to do your homework, YieldMax has some of the most interesting ETFs in the market right now. If you found this helpful, please hit like and share it with your investing group. And check out our next deep dive into YMAX, PLTY, and other YieldMax giants right here. Peace!